The S&P 500 is what we use to illustrate the actions of the U.S. stock market. This index continues to consolidate just below its three-time high right at 6,100. There are bearish signals along with its lack of ability to move above this price ceiling. Along with these bearish signals, the most important positive bullish signal is that the negative breakdowns just can't seem to develop any follow-through. It is as though the market is saying enough is enough. For all the drama and actual changes in market direction that monetary policy, economic growth, and fiscal policy can generate in the stock and bond markets, ultimately all that truly matters to the markets is revenue and earnings growth. Everything else is really sound bites from media to elicit emotional behavior. Along with the actual numbers, which we are getting now, we are getting economic indicators that are reflecting the fourth quarter of last year. The level of sustainable economic growth is also important, along with levels of inflation and levels of unemployment that might induce economic recession. That is quite a mouthful, but suffice it to say that there is a subtle chemistry that is always being measured between growth, inflation, and employment. From our perspective on this radar screen, enough good things are happening to offset the negatives and the what-ifs worry that never goes away. The S&P 500 has spent the last 2 weeks attempting to develop a leg down, but in both the past Mondays, the scares were contained. The first one being DeepSeek, and last Monday, the Tariff Tantrums. See the action in this chart. Along with the action of stock index prices, sentiment has changed from bullish to neutral on the institutional side, and from bullish to negative from the individual investor perspective. This is quite bullish if the market remains in an uptrend. This is exactly what we have at present. What we have is a market that has not moved for 3 months and is only fractionally above where it was in October of last year. Take a moment and look at the purple box I've drawn around the price of the S&P. It has moved up and down and really has gone nowhere. You will also see the bold line that I have drawn from lower left upward to the right, which validates a market uptrend that is continuing. As I say time and again, the number one thing that the market doesn't like is what it doesn't know or can't quantify. The last 2 Mondays have given us both of these, but neither of these were able to develop momentum to the downside. This is quite positive, as it merely shows that the market has been digesting its move from 2023 and 2024 and seems to be digesting sideways for another move. My expectation is a move higher, but I will remain vigilant in examining the price moves to make sure I recognize as early as possible which direction the market chooses to move in. Change is always a challenge. In our view, both the economic data as well as the direction of both the bond and the stock markets, along with the price of oil and the price of gold, appear to be doing what one might well expect given the transitions that are taking place in government, monetary policy, technology, and in commerce, business, and the consumer. While a gauge of the services sector showed some slowing after having remained quite robust for years, the gauge of U.S. manufacturing for January has picked up after a long period of weakness. Based on the ISM readings from last week, both the services and manufacturing sectors are now reflecting expansion. Not too shabby in our view. Revenue and earnings growth for the S&P 500, with over 60% of its companies having reported in the Q4 earnings season through last Friday, exceeding expectations, with earnings growth up over 12% in the period on the back of 5% revenue growth. I found a really great piece on the current changes that was written by Scott Helfstein at a research house called Global X. Global X is a purveyor of exchange-traded funds, but they also put out some superb research. Helfstein wrote a piece last week that I found particularly good at quantifying the risk at hand at this moment. It was titled Inflection Points, 5 Risks for 2025 Keeping Us Awake. The link to this report is in the video description below. Please take a moment to read this, as it covers the major issues being bantered about today that are of high importance. The opinion of the individual investor has continued to be volatile. Investors in general are scared. They are not scared of growth, as it seems to be accelerating. They are scared of what they don't know. Much like the earlier chart, ever since the election, President Trump with his Doge group have implemented changes at a speed never before seen in domestic politics. As a result of this unprecedented expediency, the measure of individual investor bullish respondents has been on the decline. This is a sign of no conviction. It doesn't mean outright negativity, but instead a period of just don't know what to expect. What I see as the biggest issue that the markets will have to deal with is what Elon Musk and his Doge group are intending for the economy by September of this year. He is targeting economic growth of an additional $1 trillion and a total of government spending cuts of $1 trillion. This would allow the economy to grow at the same amount that the U.S. government portion is removed. This would, in effect, not change the rate of inflation and add additional economic growth all at the same time. The other positive benefit would be a significant decrease in our deficit spending due to the decline in government spending. So far, Doge is cutting federal deficit spending by $1 billion per day. Their goal is $3 billion per day. If successful, this would cut the deficit by 50% in 1 year. How do we know we are on course for this? Look at the yield on the 10-year Treasury. It is dropping even in the face of lower unemployment and rising wages and increased consumption. Also, strength in the U.S. dollar. If the level of debt declines relative to GDP and the overall economy, and it does so in the face of increased economic growth, the currency will get stronger. In my view, the most important metric to remain focused on is the U.S. debt service. This is the cost of the interest expense of the U.S. debt. Although the amount of debt is important, what really matters is whether the debt can be serviced. As long as the interest on the debt is below the rate of growth of nominal GDP, then we should be okay. But when interest costs start to exceed growth, economic risks increase. This chart lays it all out. The total budget is in the top portion, and it has a line separating surplus from deficit. But the middle portion really tells this story about the cost to the economy when the federal government rescued the U.S. economy from the jaws of the great financial crisis and then the pandemic. It is clear that the interest cost associated with these huge inflows of capital is the force to be reckoned with. Ned Davis Research does a study of global recession probability. Since U.S. businesses, both large and small, seem to be energized by the new administration, and since we as a country are massive importers, it would seem logical that the expectation of global recession has continued to decline since the November 5th election. In this chart, going back to 2016, the last time Trump was in office, shows that the current expectation is at one of its lowest levels. The reason why I bring in this illustration of the probability of global recession is that now that DeepSeek, Tariff Tantrums, and Q4 earnings have dominated the market narrative over the past few weeks, it's time for the macro to start taking back the spotlight. What you need to know. Despite the constant flow of data over the past few weeks, it's had very little impact on the broader market narrative. That's partially a function of the fact that the data should have had little impact with respect to anyone's fears. But the larger reason is simply the fact that investor attention has been elsewhere, instead of what attention should be on. Back-to-back weeks of Monday chaos in the midst of the heart of earnings season will do that. Through it all, markets have proven remarkably resilient, as we've seen a nice reset in sentiment and positioning, as I explained earlier. For all the focus on trade uncertainty, it's hard to effectively pre-position for those risks. Who knows when the next media bomb will drop? Payrolls came out non-inflationary Friday, and CPI and PPI this week. This will be our next wave of economic reports for the markets to digest. In closing, I thought I would once again reflect on January action. Going back to 1950, here is a clear and graphic analysis of how years have performed when January was positive versus when January is negative. And last, what could be expected as the return this year and the probability of this. I am not looking for another almost 20% return, but I do believe that we are still in an advance. We will continue to keep you informed on the progress of the markets and will be vigilant to presenting changes that should be considered. Please let us know if any questions arise.